Revenue recognition principle. What is the revenue recognition principle? So let's start off with defining revenue. A revenue is an increase in resources resulting from the sales of goods or the provision of services. So the revenue recognition principle is a principle that states that revenue should be recorded when a resource has been earned, regardless of when the cash is actually received. So there are two main forms of revenue that involve the recognition principle. First is deferred revenue. So deferred revenue is when a company receives cash before it provides the goods or services. So for example, buying flights, you pay well in advance of actually receiving the service. And accrued revenue is when a company receives cash after it provides the goods or services. So for example, a taxi, you pay after you actually receive the service. Here's another example. This is Homer, and he wants to buy a car. And this is Gil the salesman. Homer pays Gil $50,000 for the car in February. But Homer doesn't receive the car until April. So this is an example of a deferred revenue, because Gil doesn't actually earn the money until April. So, when will Gil record this $50,000 revenue? In February or April? He records it in April because that's when the revenue is earned and when Gil gives Homer the car, even though Homer paid in February. So how is this all recorded? So it's recorded in a journal entry. So Homer's cash is $50,000 and that's when he's paid in February, and that goes into the unearned revenue account because Gil actually hasn't earned the revenue yet. So in April, he actually earns the revenue because Homer receives the car. So now imagine that Homer gets his new car service in November for $195. Homer doesn't pay for the service until December. This is an example of accrued revenue. So when will Homer's mechanic record the revenue? In November or December? He doesn't do it in December, he records it in November, because that's when he actually performs the service and when he earns the revenue. So how is this all recorded? Again, it's recorded in a journal entry, and so right here he records it as an accounts receivable because Homer hasn't actually paid yet, but he has earned the revenue. So the mechanics earn the revenue. Once Homer pays in December, it goes to accounts receivable. He credits the accounts receivable and he debits the cash because he receives the cash. Thank you for watching.